Hello, everyone. I'm Sven-Olof. I will now have two lectures, both videotaped, about corporate governance, and their second, how to manage corporate governance. I have chosen to not have these lectures live because you maybe have a signal that asks you to go down in the cellar to hide. If you have a video, you can stop the video and take shelter. If another advantage of video is that you can look at it several times, these parts where you found something that you couldn't really understand and that you can repeat it. Then we meet at the third time, and that will be an interactive when we meet. And I'm not talking so much, it's for you, and I will tell you about it at the second lecture. This lecture number one will be interrupted in the middle because I need to have a break and I need to make a short file. So let's start here with trying to share so you can see the slides that you hopefully have gotten. So this is me, Sven-Olof. I'm a professor in corporate governance at my own university, Free University of Scania, but I also am affiliated professor at your university, at Kharkiv University of Humanities, People's Ukrainian Academy. As you can see here, this is my dress for HUA. Here you can see my email. So if you have any questions or would like to send me a message, then feel free to send it to at yahoo.com. And then I have a homepage that you can look into. There are different things at this homepage, svenkolin.se. So we don't have so much time, so let's get started. As I said, there are two lectures. The aim of these two lectures is to get an introductory understanding of corporate governance. Remember, it's an introductory understanding of what is corporate governance. Lecture one, which is this video, it will be from the outside, a normal perspective of corporate governance, and that is governance of the organization and its actors. This is mainstream, very introductory. So if you are almost an expert of corporate governance, I don't think there is much in this video that could interest you. Lecture two could maybe be more interesting even for experts, because that is when I turn corporate governance upside down. I look at it from the inside. The governance, is it possible to govern owners and other governance actors, or rather, since it's about corporate management, is it possible to manage owners and other governance actors and mechanisms? So it's taking it upside down. This lecture two is a little bit more controversial because it's not really based on research that others have done and I have done, because this is not the normal perspective. So let's start with lecture one, from the outside. Corporate governance of the organization and its actors. An introduction into corporate governance without being too much academic in the sense of presenting different research results. First, what is corporate governance? There are many different definitions. Almost every researcher has its own definition. One very influential is the Cadbury Report's definition, that is the system by which companies are directed and controlled. That's a rather wide definition. I prefer more to just focus on what the governance is about, and that is the system where the will of the owners are implemented in a company through controlling and facilitating managerial action. That is to identify that there are some that are more powerful in governance. This is not just a system like this, but there are more powerful actors that have a will, that try to implement that will in a company by controlling and facilitating managerial action. Very often, we, the researchers, think about corporate governance in terms of mechanisms. So it's a kind of mechanistic idea that if you have a will here, you have the corporation here, they can fit together, and then like in a machine, there are mechanisms that can make the corporation run in the way that you would like it to be run. So then we have a kind of a mechanism definition saying that there are a set of mechanisms that have several functions by its own, but one function of each mechanism is that of influencing the firm, and especially the top managers, but also the board of directors and the employees of the corporation, but especially the top managers, making them oriented towards this part, making them oriented towards, that is saying that try to direct these people's attentions and even will towards the satisfaction of the principal. And the principal considered to be those that are the dominant stakeholders and the needs of those stakeholders. That is especially concerning owners, those that we tend to call owners, but more correct, if it's a corporation, joint stock company, more correct is to say shareholders. So it is about the mechanisms that are trying to influence especially top managers in order to make them satisfy the principal's needs, that is the main stakeholders, probably shareholders. So that is corporate governance. The subject of corporate governance, that is, who is the main actor? Because I said it is a set of mechanisms that support the fulfillment of the will of the principal. So there is an idea that there is a certain party that's called principal. The principal is the party that have legal and institutional rights to implement its will in the enterprise. So you have to realize that it's both illegal and institutional rights. That means that there could be some that are considered to be principals because they have an institutional right to influence, but they don't have any legal rights to do. That is typically appearing in, for example, family firms, where there are a family, maybe two of the family members are the owners, but the family as a whole is considered to have the right to influence the corporation. And then there is the agent. The agent is the party that is employed, that is used in order to manage the enterprise, in order to fulfill the principal's will. So the principal and the agent. And there is a kind of obeying hierarchical organization that the principal is above the agent. And the principal tries to influence this agent, so the agent performs things that satisfy the needs of the principal. Well, then we have, of course, the scientific problem. Who is the principal? Sometimes it's really not so easy to identify who is the principal and have the legal and institutional rights to influence the corporation. And then the second, what is the will of the principal? Very often you will see in studies that it is assumed that the will of the principal is profit maximization. But even that one sounds very, very simple. It's kind of hard because profit optimization, if you have read your finance literature, you know that there is profit and there's the risk. And if you increase the risk, you will increase the profit. So what is the optimization of profit? It is profit considering a risk. So it becomes even more complicated. And it becomes even more complicated if you, for example, study or work in a family firm, because in family firms, it's normally assumed that they are not optimizing profit under the shell of risk, but they have some social goals also, especially the social goal of making the corporation survive so they can give it to the next generation. It's called social emotional wealth. So in this case, profit is considered to be a restraint and an opportunity that will hopefully increase the social emotional wealth, increase the capacity of the firm to survive so it can be handed over to the next generation. So the will of the principal is not so easy to find out. And then the second layer of here is the political and normative and ethical problem. We are dealing with corporations, we are dealing with wealth creation. Who should be the principal? What in a righteous society, who should be the principal? Should it be the shareholders? Should it be the top managers? Should it be the employees? Should it be the government? Should it be the commune? Whatever. And then the second is, what should be the will of the principal? Should it be profit maximization? Should it be, as it's very important today, sustainability? Should it be the maximum of satisfaction in society? Yes, but we are focusing more on the scientific problem. Who is the principal and what is the will of the principal? But here we don't have really, we will not dwell into these. We will only focus on mentioning the governance mechanism. But always remember, when we talk about principal and agent, this is the view. And then who should be the principal? Look, here is a list of those that could be a principal: shareholders, the state, the government, the managers, the nature, the suppliers, the society, the neighbors, unions, customers. And think about it, those that are not yet born, but that will be born. The idea with sustainability is that we should create a society that unborn people, those that will be born, can live in and make their choices. So it's really a mess. But normally we assume what is up here, the shareholders, that they are the ones that are the main principals. And then often also unions. For example, in Germany, in German corporations, the unions are quite strong, and as they are in Sweden. The object of corporate governance, that is the agent, while the principal is the subject. The object of corporate governance is the agent, and that is mainly managers. And with managers, they are human beings, like you and me. And in economics, we tend to make assumptions of about people's motives for behavior. But we assume one, that is boundary rationality, that is that humans have limited knowledge. They don't know everything. The life would be so much easier if everyone knew everything, what has happened, what happens, and what will happen. Then there will be no problems of governance because no one can cheat and no one can be lazy and no one can try to do something that I don't want to happen because I will recognize it and I will be immediately capable of intervening. Lucky for us, we are bounded in our rationality. Imagine if you knew everything, what has happened, what happens, and what will happen. It will be so extremely boring that life would be meaningless. So we are bounded by rationality, and then we have the opportunism. And opportunism is kind of an assumption. It could be the assumption of egoism that everyone is looking for themselves, but it could also be a little bit weaker that we have self-interest. I'm doing what I think is the proper action. It doesn't mean that I'm doing something that is giving me the most wealth, but it means that I have a self-interest. I have an interest in what I'm doing. Maybe I do it for the purpose of sustainability. Maybe I do it for the purpose of profit. Maybe I do it for the purpose of me gaining a lot of wealth. Maybe I do it because then I will get status and everyone will hail me when I come out in the golf course and so on. But it's self-interest. And those two assumptions, boundary rationality and self-interest, creates conflicts between humans. We have different interests, we have different views on what should be done. And that creates a conflict. The beauty, one could say, of corporate governance is that corporate governance is trying to find how to align the interests and actions between these different groups. Then the dark side of governance is that this alignment of interest and action is a hierarchical alignment because it's alignment of the interest and actions of the humans of the organization with the will of the principal. So it's the will of the principal to set that sets what is the proper interest and proper actions of humans in the organization. So these are the assumptions. Then you can always say that, these are not good assumptions, they are not realistic. Well, they are assumptions. If you have better assumptions, present your assumptions and create a theory, and we will then discuss that theory. Now, we have this topology of corporate governance mechanism. Here, here I've tried to create an image of the enterprise as such. The enterprise, that is the mean in order to produce those things that could satisfy the interest of the principal. We have an input, we have a transformation process, and then there is an output. And we can link the corporate governance mechanism to these three parts of the enterprise. And here that below, I have a list of the governance mechanisms. And these are capital. You could say, well, in a way, money. We have the external managerial labor market. People that are coming from the outside entering into the corporation and work there. We have the internal managerial labor market, that are managers that are working and get promotion within the organization. We have executive compensation, the payment to the executives. Some people claims that these compensations are giving incentives for people to act in the interest of the principal. We have the organizational strategy, in the direction of the corporation, the market they are operating in, the products they are producing. We have the organizational structure that contains both the board, but mainly how the organization as such is structured. And then we have finally auditing. Here it's considered into the transformation in the enterprise, because auditing is an internal work made in order to make sure that the information that the corporation is giving out has a level of assurance. And then on the output, there is the product markets that discipline the organization. So these are the different mechanisms that I will present as I said in a very introductory way. You know, I have a master course that is going on for full time, 40 hours every week for 5 weeks, dealing with these mechanisms. So this is very introductory. And I hope that you will understand at least small parts of what mechanism, of the different mechanisms. Then there is a total environment in which these are embedded, and that's the environment where there is a culture. There are different cultures in different countries, state legislation that influence the corporations, regulations. There are the regulations on the industry levels, for example, and then quite influential is the mass media, economic journals and televisions that influence the corporation and the actors in the corporation. So this, when you can repeat this image, then you don't know the content of the mechanism, but at least you know the definition of corporate governance, where the definition is the governance mechanism. So we go to the next slide. And that is, I ask you to remember that governance has always two sides. There is one side that is always stressed, and it's stressed too much, which makes people forget about the other side. But if you don't think about, and if you don't act according with the other side, it will not go well. The most stressed side of governance is the disciplining and guiding part. That is when you talk about incentives, monitoring, giving orders. And that is what people think when they think about governance. And governance is that try to restrict people so they don't do this and this and this, but do only this because I want them to do this and therefore they should do that. And that is disciplining. You almost put them in a prison where they can only do one thing, the thing that you think is right. That is the disciplining and guiding. That is probably 95% of, if you read the articles about governance, corporate governance, it will be focused on disciplining and guiding. But the other side is, what's the point of having people that are doing what you think they should do if they cannot do anything that develop, if they cannot contribute with their own ideas? So the other part of governance, the other side, is the enabling and empower. It is giving people discretion so they can act. If they have a good idea, then they are acting. It's promoting entrepreneurial action. This is more, one could say, the developmental part of the enterprise. And imagine if you have a corporation that do not develop, then it will slowly die. So this is enabling and empower. Unfortunately, corporate governance studies, corporate governance discussions are very seldom stressing the discretion part, the entrepreneurial part. The next lecture, when I will turn corporate governance upside down, I will focus on how the CEO and the top managers can manage these governance mechanisms. So that is kind of using the discretion, but it's an empowering on upside down. So the last text here on this slide is saying that governance is not, I will stress, not making people obey. Because if they obey, then what's the point of having people that obey? Because I want them to work, not obey. Because obeying means that I can tell people what they should do. That's not possible. If we have boundary rationality, it means that some people knows what should be done in these circumstances, and some people don't. I could tell them that, could you please, for example, when you do this, when you are doing your work here, if you're making a master thesis, maybe your supervisor will tell you, well, you have to make a regression analysis. And But then because the supervisor realized that this is what has to be done, but the supervisor maybe don't know really what it is to do a regression analysis. The supervisor maybe only knows that it had to be done and it can create this kind of results. So it's not about obeying, telling people what to do. It is about making people capable of performing and therefore realizing or beating the goals that have been put up. And then I have a device or pay attention, please, that governance is highly political. So pay attention, please. Governance is about wealth, not so much wealth creation, but wealth consequences, and about power, about power distribution in corporations. So it's these two things, that is about power and it's about wealth, makes it highly subject to political interest and political power. The world is scattered with people that say, this is the very good governance, this is how you should govern your corporation. But then ask them, what kind of scientific proof do you have? It's really surprising how little we have managed to show where one mechanism, if you do the mechanism like this, it will create superior performance always. And one reason is, as I told you, performance maybe is not profit. It's not profit considering risk. It could be social, emotional, wealth, whatever. So when you see these theories about corporate governance, they are not objective truth. They are not independent of interest. When you read, if you really study it intensely, you will see that there are hidden values in theories. For example, agency theory, that is the dominating theory in corporate governance studies, tend to be supported by shareholders and right-wingers. They are the ones that like agency theory. And of course, because agency theory says that shareholders are the principals of the corporation, and everyone should obey what they are saying. But the corporation is there in order to support the will of the shareholder. Of course, if you are a shareholder, you like that kind of theory. It doesn't mean that it's correct. It just means that it's very useful, especially today, when there is a tendency to let the shareholders, or at least some shareholders, be the principal. Then we have institutional theory, and that tend to be supported by employees and left-wingers, because it says that society create norms that influence the corporations. And that is also true, but it's not the whole truth. So be very critical. The university have a motto, sapere aude, dare to know. You have to have courage to use your own understanding. Don't believe. Try to get knowledge, which means that you have a critical thought. So that was a very long introduction. Let's get on with the mechanism. The first mechanism, maybe one of the most important one, is capital. And capital consists of equity, debt, and free cash flow. Especially here, we focus on equity. Equity is the owner's capital in the corporation. It's the shareholder's capital. I use owner, shareholder like this, like synonyms, but maybe they are not. Maybe shareholders should not be considered as owners, but they are still shareholders. Shareholders are organized in a stock market, if the corporation is listed on the stock market, or it is consisting only of ownership capital when it's not a listed corporation. Equity has demands of profit, and as I said, the combination of profit and risk. And different shareholders have different preferences for profit and risk. Some shareholders would like, for example, if you are a pensioner, you would like to have a stable profit without high risk. If you are a very young shareholder, you can assume higher risk because that creates normally also higher profit, but also higher losses. And that you can afford if you are young. So the character of the shareholders create what kind of preferences shareholders have for profit and risk. Then some have also demands of dividends. Dividend is when the corporation pay out to the shareholders each year some part of the profit. That is preferred by some shareholders because if a corporation has to pay out a dividend, that means that the cash flow within the corporation will be reduced, the free cash flow. And if you reduce the free cash flow, the managers in the corporation cannot use this money in order to invest in some absurd thing. So to reduce the free cash flow through dividend is one way of controlling, to disciplining the managers. And of course, yeah. Then there is capital rationing. The capital rationing is that you give a certain amount of equity to a corporation, but not too much. That is that you control the supply of the capital to the corporation. And if you control the supply of the capital, you also control the investment, because then managers cannot invest in whatever. They are restrained in what kind of investments they can do. Therefore, capital rationing is very important in order to keep managers focused on specific investments. Then there is the takeover market, the control market. Takeover market means that potential shareholders can go into the stock market, buy shares, take control of the corporation through the voting rights, throw out the whole board of directors, and put in a new board of directors that have one first goal, and that is to fire the CEO and to replace the CEO with another CEO and to change the corporation. So takeover market is a very strong mechanism of control because it's intervening and cleaning out the personnel of the top management team. Therefore, that's one major function of the stock market is to have this threat of takeover, because that will discipline managers to perform, so there will not be any pirates coming around and buying up the shares and then throw them out. Then we have privatization. Privatization is when you buy the corporation from the stock market and you privatize it. That means that you take it off the stock market. You make it a private corporation, not a listed corporation. That's quite popular, but some managers like it, some managers don't like it, because it's a little bit more fashionable, I think, at least in Sweden, to be a manager of a listed corporation that appears in television and all these things. But the private corporation is the kind of silent that doesn't show so much face. And then we have the nationalization. Nationalization is when the government buys all the shares, take over the corporation and make it a part of the government. That is nationalization. So these are three means of changing, how to change the owners. And when there will be an ownership change, there will probably be a change of board of directors and on the top management level. So those are threats towards the top management team of the corporation, which they will try to influence. So probably it's not so popular to be nationalized as it is to be privatized. Remember that those that have the shareholder capital are the ones that have the right of control of the corporation through electing the board of directors. As an owner, you cannot really influence the corporation, but you can influence the election of the board of directors, and then you can influence the board of directors. For example, if you are an owner, you cannot fire the CEO. No. It is, but typically in most countries, according to legal rights, it is the board of directors that employ and fire a CEO. But then, of course, if you have an ownership of 80% of the shares, and you tell the directors that you fire this CEO or I will fire you, then of course they will listen. But then we have some interesting thing, and that is the client effect. It's called a client effect because that is to say that corporations as such attract certain owners. Those owners that have a high demand on the dividend, for example, old people would like to have dividend because then they can get money and go to trips in the different countries. They tend to be in corporations where a high level of dividend. When you are a young person, you don't really need the dividend. You have your income from your salary, and you need a increase of wealth so you can get a good pension in the future. Therefore, you don't need the dividend right now, so you will not be in a dividend-intensive corporation. And then finally, the most dramatic part of this equity mechanism is bankruptcy. Bankruptcy means that you are firing bad owners. Bankruptcy doesn't mean that the corporation, that the enterprise in the corporation will dissolve. The enterprise could still exist, but what happened is that old owners will disappear, and you will sell the enterprise on the market, and there will be new owners. Going to the next mechanism is in capital is debt. Debt is traded on capital markets and in form of credit capital. Typically, you loan money from banks, or if you are a big corporation, you can lend it through on the capital market. What's specific with debt is that they have an interest. An interest is that there is a demand. If you lend out money to a corporation, there is naturally an interest. That is a demand to get a yearly income from this money. That is not in the equity. Equity don't have the right to demand payment every year, because if there are losses, the corporation cannot pay anything to the equity, because equity is what's called residual capital. Residual means that they get what's left. And if it's a good year, then there is a profit, then they will get some profit. It's a bad year, there is no money, so they don't get any payment. That is, for example, dividend. But when it concerns debt, there is always a payment. You always have to pay the interest. You cannot say, oh, this was a bad year, I cannot pay, sorry, I don't pay the interest. You just try to tell the bank, oh, sorry, I cannot pay. They will make you pay. That is why we say that interest never sleeps. And that has induced the researchers and some owners also to have a high level of debt in a corporation, because that a high level of debt means that the corporation has to create all this profit in order to be able to pay the interest. And you have to pay the interest, otherwise you go bankrupt. So high level of debt means a pressure for the top management team to perform in creating profit. Then you have to give collateral and surety, that is claims on property of the corporation, or you need a person, a party that assumes the responsibility of the loan if something goes bad. Normally, also those that lend money have access to internal information that equity owners do not get their hands on. So it's kind of there is a preference for this capital, credit capital. These claims of property makes it quite dramatic, because if you cannot pay your interest, the bank will come and take the property out of the corporation, which maybe the corporation probably needs. So that will be really interruptive of the corporation. What's typically for debt is, while equity controls the corporation, the enterprise under normal business, the control goes to debt when there is when they are facing bankruptcy. When they cannot pay the interest, then the control will be turned over to debt, and the equity will be, as I said, fire, bankruptcy. So there are claims that it's very good for corporation for creating a good performance, profit-oriented performance, if you have a high ratio of debt to equity. Much debt that never sleeps, it's good. Then, of course, you have the public organization that's owned by the government. There is the surety of the taxpayers, so it's kind of a risk-free interest. And that has been used in order to explain why public organization, that is governmental organization, are not performing so well, because they don't feel the pressure from the capital market. Next mechanism is the market for managerial labor. Market for managerial labor means that it is about how you internally and externally recruit managers and how you promote them inside the organization. That is the market for managerial labor. To be external, you pick someone from the outside and put into the corporation, or it could be internal. You have people in the organization, you promote them to higher managerial positions. It could be preferable depending on the situation. When one looks at the managerial labor, you look at the capacity of the individual. And here is a thing called adverse selection, and that is especially in case of external recruitment. Adverse selection means that the individual that would like to have a position at the corporation present itself as being very good. Think about yourself when you go to a employment interview. You don't start by saying, "Oh, I'm always very tired in the morning, and I don't like bosses. I would like to kick them in their bottoms. And I would like to go very early from the job, and a salary less than 10,000 euros a month is insult. What would you like me? So?" That is not a good way to present yourself, and that is probably not, even if you would like to, even if it's true, you start by saying that I'm very engaged, I'm very attached to my work. I tend to be using more than less energy in my work. And that is your promotion of yourself. That is adverse selection. If an employer would listen to you and say, that's the truth, the whole truth, and nothing but the truth, they will, of course, employ you. But they know that this is adverse selection. There is a bias between what reality is and how it's described. And that makes it hard to recruit from the external, because there is always this adverse selection. It's easier internally because then you have objective, you have your own information about these individuals, so you tend to recruit those from the inside. And competence of the individual is even more stressed and easy to find out, because you have seen them working in a position, and you know how they are functioning. Maybe also know about the mindset, because when you go to higher levels, you would like to recruit people that have certain mindsets, that think preferably the same way as the CEO, at least. And then the last is the characteristics of the individual and the team composition, because people are not single. They work in an organization. In an organization, there are teams and there are groups, and people have to fit in. So maybe the most energetic and the best one and the world champion of something maybe is not the best person, because this person has to fit in a group and create a group performance. And that is when we come to diversity, for example. Diversity is a norm that is highly appreciated today, but we also know that diversity, especially when it's ethnic diversity, creates tensions in the groups, and tensions consumes energy, which then, of course, lower the performance. On the other hand, it these tensions could also be very driving development. So you have the tensions and you have the development. But then there are mechanisms in order to reduce the tension. I will talk about them the next lecture. But all these managerial labor market is about saying that governance would not be any problem if you could pick and find one person that is just perfect to fit in and fit your demands. But unfortunately and luckily, people are not perfect in any sense. Let's go to the next mechanism, and that is executive compensation. Studies have found that executive pay here could be explained by 40% due to the size of the firm. The larger firm, the more executive pay. That is 40% of the variance. 5% of the variance of executive pay could be explained by the performance of the firm. That's really surprising, one would say, because what you are probably teach somewhere that executive pay are in the compensation to people is looked at as incentives. They make people work harder or less hard, and therefore one would expect that there would be a perfect correlation between performance of the firm and executive pay. That is not the case. The more correlation is the size of the firm to executive pay. And when we look at size of the firm, whose interest is it to have a large corporation? Well, that is the goal of the managers, to look at the size of the corporation. A big corporation, I'm a top manager of a big corporation. You go to the golf course, everyone would say hello to you because you are very important, because you are a CEO of a large corporation. Size of the firm is of no interest for a shareholder because they would like to have profitability. Profitability sometimes is correlated to size of the firm because of economies of scale, but sometimes not. On the other hand, this correlation to the performance of the firm, that is the interest of the principal. Profit is the goal of the shareholders, and that is supported by 5%. So in this game, one could say that it's 5 to 40 in the principal agent game. So that is called a compensation paradox. And what that is, stop sharing. And what that is, I will tell you in the part 2 of this video, because now I will stop the video and I will take some water.